just a reminder that, just a couple days ago, we had some decent sized swings. And last week, the behavior that we've had since early yesterday is not typical behavior, and it's not behavior that's going to stay with us for long. The market is always trying on behaviors, and I'm not sure of the logic, why it does that, why it has big swings and then tiny tight trading ranges, and why it just goes from one to the other. It might be that the program traders keep playing a certain type of program until the profitability reduces, and then they know that they should start trading another type of program. That other type of program may tend to generate tight trading ranges. I don't know. I'm guessing it's something like that. I know that if I were running an institutional program trading group, I would pay attention to all the different programs, and I would be aware of their tendencies. And one tendency would be, as I said, if a particular program is doing very well for 2, 3, or 4 days, and then the profitability is starting to go down, I would be inclined to switch to another kind of program, especially if I knew from experience that once program A starts to become less profitable, then program B tends to become profitable. And if I knew that, I would start trading program B, and it may be that program B results in tight trading range type trading, and if enough firms are using similar thinking, the result is the kind of trading we've had for the past couple of days. But at some point, the profitability of the programs that are trading right now will reduce, and the program traders will switch to other types of programs. And I don't know if that's what's going on. And frankly, I don't really care. All I do know is that when the market's in tight trading ranges, I tend to take fewer trades, and I know that just a temporary phase, and it'll might last 2 or 3 days, and then it'll go away. So we've had it for a couple of days, so I'm assuming that it will be gone tomorrow. But if it's not, I don't care. I mean, I prefer that it's gone, but if it's not gone, I know that it will be gone soon afterwards. Okay, coming into today, I had 2 thoughts in mind. One is that yesterday was mostly a tight trading range day except for 1 bar. And the second thought was that we have a report tomorrow that the market pays a lot of attention to. So that creates uncertainty, and uncertainty increases the chances for a trading range. So we have the tight trading range from yesterday, which could be a magnet and pull the market back down, and then we have the uncertainty of tomorrow, which would tend to create trading range behavior today. But nothing is absolute, and clearly, my thinking didn't work today. The open first bar of the day, breakout of a tight trading range, close near its high. Possible. Every first bar of the day is a potential trend from the first bar setup. I did not buy this, but when we had the strong close on bar 2, I started placing limit orders to buy at the low of that bar and then at the low of the next bar. Once I have 2 good bars, I'm assuming that that any pullback will be bought for at least a test of the high. And obviously everyone had the same thought because there were no pullbacks. There's bar 3. Bar 4, a tail at the top. Normally a tail at the top means that the market will create a pullback. We have a report coming up, but they bought 1 tick above the low of bar 4. So they were obviously very aggressive. The big money believed that the market wasn't going to fall below bar 4. Bar 5 was an inside bar going into the report in a doji, and so I didn't buy that. Bar 6 was a good-looking bar. Bar 7, both no tails on the bottom. So by the time bar 7 closed, the market was always in long. Bar 8, the first bar with a big tail after a series of bull trend bars. So that to me is the end of buying the closes. The first bar of the big tail or the first bear bar usually means that the market is going to try to correct sideways to down. there's a high 1 above 9, and I don't think, I certainly wouldn't buy it because there's too much chance that we're going to have at least some kind of a correction after bar 8. I certainly wouldn't short below 10. That's an example of an OIO, outside, inside, outside. The market's up way too strong, and traders are going to be looking to buy pullbacks. The market may try to hold above the 8 low as the pullback into the measuring gap between the 4 high and the 8 low. There's a high 2 at 11, and I think that's probably risky because you get 3 overlapping bars of good size forcing you to buy at the absolute high. Got a doji. You can argue breakout pullback at 13. That there was a bull flag to 11. 12 is the breakout. 13 is the pullback. We're starting to get 6 overlapping bars. We have a bear bar. We have tails. We have a couple dojis. That is the start of a tight trading range, and I'm not going to buy above any bar. I would only look to short above the highs of bars and look to buy below the lows of bars. And if I'm buying, I want to be buying in the bottom half, maybe the bottom third. And if I'm shorting, I want to be shorting in the top half or top third of the tight trading range. 3 little pushes up now at bar 15. So the market may have a small pullback here. Okay, outside up on 18. Almost a double bottom bull flag with 11, maybe 12. I think it's tough to buy outside up when you're buying in the top half of a tight trading range. And I think it's tough to buy above 18 because it's at the top of a tight trading range. You can see the hesitation on 19 and 20, but then outside up again. So this one's up to a new high, so it's a potential breakout bar. I always want to see what the bar after it does. The tail on 21 on top is not great for the breakout traders. The pullback on 22 to below the 20 high is not good for the bulls. So we're probably going to go more sideways. You can view 6-7 as a bull spike, and the move up from 11 as a bull channel, and it's not a very strong bull channel. Lots of overlaps, lots of prominent tails, lots of pullbacks, some bare bodies, and an II at 23. Arguably some kind of wedge top with 15 and 21. I personally don't want to be shorting yet. The biggest pullback so far today is 9 ticks, and if I'm going to short below a bar, then I'm in 5 ticks below the high, so I need an 11 tick pullback to happen, and I don't want to bet on something that hasn't happened all day. The market's been going on for 2 hours, and I don't want to bet that this time it's going to happen, even though it hasn't happened in the 3 or 4 prior pullback attempts. So to me, I'm not interested in shorting just yet. 26 I think is interesting because it's a bad looking high 1. So I do think that's probably an okay short for a scalp. But again, it's risky because if you're short at its high, you're 3 ticks from the high. The biggest pullback has been 9 ticks. You need to go 4 ticks down. You're barely in there. Okay, new high of the day. Second entry at the same price as below the 25 low. Arguably a short. I didn't take it because of the biggest pullback so far today was 9 ticks, and I don't want to be shorting 6 ticks down from the high. At this point, 31, 32, you have to bet that there will be buyers at the moving average. 32 is a 2-bar reversal and a high 2, where 27 was the high 1 entry. The move down from 29 was reasonably hard, so I would not buy this. I'd want to see if there's going to be a third push down and a wedge bull flag. I didn't short above 32, although arguably, actually maybe I did. Actually, you know what? I think that's one of the shorts I did take. But anyway, as I said, I wouldn't buy above there because I think that tight trading range, we're so close to the moving average, and we have a lot of two-sided trading that we should hit the moving average.